All right, we're here with the commodity report. Looks like I scheduled the time a little bit off. Sorry, guys, on YouTube. But I am traveling, and it's honestly a miracle that we're doing this, and me and Kevin got the time right because I'm literally about as don't want to say a ridiculous word, but I'm literally about as dumb as it gets when it comes to time changes. Whenever the time changes for me, I'm just like all over the place. Like I have no idea what's going on. I'm like the worst at it. I don't know why. It's like something in my brain. It's like you're from Cleveland. You're always from Cleveland. You're gonna be at this time frame at all times. So we're here. You know, barely slept for me, but we're here today, and I'm glad to have Kevin on. I wanted to get Kevin on before he leaves on vacation. So going through the commodities real fast, we'll start with energy. Energy looks like it's oil, especially, has been in this base pattern for a while. I'm still really looking for some decision here. Getting over 80 would be a decision to possibly move to the upside. Getting below 78 and a good close below 78 would be a decision to move to the downside. Natural gas, though, continues to just break up day after day after day. That's been a wild move, but that's how natural gas always goes. Kevin and I were talking about the short squeeze effect, especially Kevin was talking about that the other week, just last week. So if you go to last week's report, you can see us talking about that as well. Gasoline, a little bit stronger than the rest, but at the same time, it's still at that same zone. I'd be looking for it to get over 260 to really think that it has some upside to go. Cocoa, after its huge run, has just basically went sideways to down ever since. More down than sideways, even. We've been out of that trade now for a bit. We'll see where that ends up, but right now, no longs on cocoa and no shorts at the moment either. It could break down into a good short pattern coming in here soon, breaking under that zone above below 7,300. Cotton, still not a buy. It's definitely in a sell still. Orange juice has continued to just break up higher. Looks very similar to natural gas. If you check it out, you can see a nice band squeeze breakout pattern that happened in orange juice. That's continued to be a good trade we've been holding. Coffee finally moving back up. Coffee did come back quite a bit in our portfolio, but now it's moving back up. That's very nice. Sugar trying to bottom. It doesn't seem like it is. I wouldn't buy it here. A lot of people continue to want to buy sugar because it looks cheap. Commodities that look cheap it's a terrible thing to try to do because cheap can always get cheaper. And that's with anything in trading, but commodities especially, when they're trending, they trend. They trend up, they trend down, they move on in huge moves one way or the other. They're not very mean reverting, so they're trending down. Don't buy it. So I wouldn't buy sugar yet. I'd continue to wait for some more strength. Look at cattle. We got live cattle. Live cattle's just kind of still in this range, really looking for that to make a decisive move up or down. It's been in a huge range since the end of 23. Basically, September 23, it topped, and it's just kind of created a triangle pattern. It actually looks like a continuation pattern to the upside, but it's still just chopping around. So a lot of chop there. Feeder cattle looks a lot stronger. Feeder cattle is very close to making new highs as well. So it can make new 52-week highs any day now. And lean hogs, after a great move, it's come back a bit. Doesn't look terrible, but not something you wanna be buying here either. Long-term portfolio, it's still a long, but it's getting closer to a sell as we move forward. All right, Kevin. So what are you seeing in the commodity markets in the last week or so?
Yeah, I've been trying to track it, but I have taken some time off here. All right, let's kind of go through. So for energy, oil did test the $80 level. It rejected it, trading at around 78.88 right now. W- Once again, it's kind of broken the ascending channel that we saw, this megaphone type of channel that actually it did form into. And now the resistance area has been the lower band of that channel, which is a little concerning from a technical standpoint, right? You want to be able to break above that on large volume. And I think that would be the key signal that we could actually recapture some of these this price action here. When you're looking at the dynamics from the energy space as a whole and some of the fundamental data that's out there, we'll continue to talk about this every week. I don't see anything that structurally shifts the price range that I've kind of been looking at, 80 to 85. We've been trading below that for the last 2 weeks or so, slightly below that. But we haven't seen a dramatic shift when it comes to energy. Consumption demand is kind of stalled out a little bit. I think that's one of the reasons or one of the factors. But we got some data over from Saudi Arabia last night. Their production numbers have definitely gone down. Exports actually have sustained themselves for the most part, so they still have some tightened supply. And we still have a slight backwardation when it comes to Brent as well as crude oil, which is for the most part bullish, right? So the inventory story has not really fully emerged yet as far as gluts, but we definitely see maybe some cracks in the armor when it comes to the price action here. So that's kind of what I'm keeping my eye out on. We talked about heating oil a couple of weeks ago as well, or diesel. Starting to see some green shoots there, a little bit about performance over the last couple of trading sessions. So, and just for people to kind of have a perspective, when we talk about outperformance, we talk about relative to another product. So if you have crude going down 2%, but heating oil only goes down 0.7%, heating oil is still outperforming on a relative basis. So we have to keep that in mind. But heating oil, if you're looking at a weekly chart, RSI has bottomed, start to move to the upside. Stochastics has bottomed, starts to move to the upside. Volume, we have like a volume spike, kind of that reversal type of candle, if you will, that has come up. And so I'm kind of keeping my eye out on that. And that would be my leading indicator for going into maybe seeing another resurgence when it comes to gasoline prices as well as when it comes to crude prices. Just understand the dynamics on a fundamental basis is different from each and every one of them. Diesel had inventory gluts, and this has had inventory gluts over the last 2.5 months, 3 months, which is why the price action has gone to the downside. And then you also lost the seasonal factor when it comes to diesel as well, right? And we know what's happening in the transportation side. Gasoline for the first 3 months of this year was in a deficit. Now we are starting to see the gluts happening in gasoline, which is why we're kind of seeing that break to the downside. And then you have this kind of like stalling out in demand for gasoline. That is kind of the crucial thing there. And then when you're looking at oil in itself, you're losing the geopolitical side of it, and then also once again waning from when it comes to the byproducts itself. But we're also seeing some tightening of the screws when it comes to the energy producers, rig counts going lower, refining rates pretty much staying at around 88.5%. It hasn't really spiked to the upside, hitting 90 or 91% yet. So that's actually a good thing to see as far as if you're a bull in that, right? Constraining supply. So that's kind of what I'm keeping my eye out on that. 200-week moving average still has been broken for heating oil. I'm still concerned about the broader equity market because of that particular signal, but that's not my only signal, but it is a big signal that I do focus on. Natural gas, still getting that pop. So that's a short squeeze that's taking place. There's a thematic that is out there too around AI and consumption. I'll talk about that in a little bit because I wrote about that this morning. I think that's going to be a good conversation. But it's more being driven by the fact that we're having warmer or projected warmer days this year, which should actually increase consumption demand, which would then obviously move prices to the upside as inventory levels for the most part have kind of leveled out. And then we have LNG export demand going up as well. China is now, restarting or revamping some of those purchases. So that's what we're seeing from Natty on that side. I'm never going to tell anybody to fade a move. We kind of talked about a couple of months ago. At some point, Natty was going to catch a bid just because it was definitely oversold. And then you had the geopolitical risk that's there, which I think it still provides more upside risk from the geopolitical side of it. And then you had the weather factors that were taking a part of that as well. I'm still a little bit skeptical that we are going to be able to maintain these price levels. Let's say when I say I'm skeptical that we would be able to maintain $3. That would be my thing. But I wouldn't say fade it right now because the short covering is still fairly aggressive and there's a long way to go. We're only about 20% of the way there when it comes to these managed money players actually covering their shorts, right? So there could still be a lot more action to the upside. And it's just very important. Like when we kind of have these conversations, you and I are completely different. I usually look at 1 week or 2 week terms unless I state otherwise. And this is kind of that as I state otherwise type of situations here, the sustainability of this price action for, let's say, the next 3 to 6 months, I feel like is going to be fairly difficult without a very strong geopolitical catalyst for us to stay this way. But I wouldn't fade it either, right? It's just something to just kind of keep your eye on.
Yeah, I mean, it's something I talked about the other day, which is kind of an interesting thing to just think about, which is when you're a trader, and let's say we look at the fundamentals, we all do. Whether it's funny because it's the same thing. Like fundamental people act like they never look at charts, and it's like when you put on a trade, most of the time you do look at the chart, you do look at levels. Even the most fundamental people I've ever met still do that. It's the same as the other direction with technical analysis people. We still live in the world. We still see certain things. So I mean, it's not that nobody's all in on one style or another. But what I'm trying to say is when you're a trader and you have the fundamentals not making sense for a little bit, and the move is making sense in some way, and it just meaning a trend, a breakout, something's fundamentally changed, and I'm not sure what it is. Sometimes we won't know exactly what it is for a while. Kevin and I, a while ago when we had that trade in oil, beginning of the year, all we knew is that there was a possibility of some sort of catalyst, and there was a million possibilities. Not really a million, but there was a few possibilities. And then the catalyst actually happens, and then boom, here we go. Like, here goes the trade. The trade starts to move. So once again, it's going to be an interesting thing. I'm not exactly sure why natural gas is where it's at. Either way, it's been a great trade. At the moment, it's well in a profit. It's looking good. I'd continue to ride the trend, like Kevin said. Don't fade it, for example. And I wouldn't buy it here either. But I would definitely not try to short something that's moving up this heavily. Either way, it could just be as simple as, and Kevin and I see this all the time in the commodities market. It could be as simple as an unwinding of positions. I remember there was a trade in palladium. What was this? This was 2 years ago. I think it was 2022. I can't remember. It was literally the most skyrocket trade I've ever seen in my life. It literally went from, let me pull up a chart of that just to actually say this correctly, because this is actually a very interesting thing that everybody could kind of learn something from, because it was a very odd trade that happened. So if you look at palladium, we go back to the end of 21 into 22. We basically have a breakout there. It moves from just around 2,000 all the way to 3,500 in like weeks. This is just weeks of just this crazy move higher. But it was this spike top. It actually made new highs, but it was basically a blow off top, and after that it just came down very quickly. Now it got into that. Part of it was the Russia-Ukraine crisis. That's what created the spike top. But also it's a good lesson in the fact that these like basically the positioning needed to be unwinded at that point. It was very lopsided. You had a lot of short interest at that time. And as that basically got to that top and the position unwinded, or finally got back to equilibrium, it just basically went into a downtrend ever since. So once again, commodities are very volatile. So we can trade them. We can make some good moves, make some money doing that. But we also have to know that commodities are very volatile. Like Kevin said, I agree that this move could be, and this is why Kevin's so good at what he does, looking at it in a very in an angle where you can go, okay, well, this is a point where I wouldn't be buying. This is a point where I might move up a stop. This is a point where I might pull my position size down. Like there's all different ways to risk manage. So taking that advice of, hey, here's a good point a good time to manage your risk, be a little bit smaller, be a little bit more tactical in your trade. That's very valuable.
Yeah, right. And so for the other side of that, the reason why I say, I don't know if this is the immediate top right now is because the the contracts all the way out till August have also coincided with this move, right? And so certain contracts you want to look at their backwardation or their contango markets, and contango, that sounds very fancy. It basically just means that the front month is priced less than the further months, right? Because you have storage costs, you have carry costs, you have transportation costs, blah blah blah, right? So in a normalized market contango means the same thing. You want to be cool at the bar, you say, yeah, this market's in contango. That just means normalized market. Okay. And then you have backwardation, where you have the front month contracts priced higher than the next month out, right? And that's usually in a market that is seeing immediate short-term demand in the market, or you have like a weather event that occurs, or you have just like this huge FOMO type of scenario that takes place. Natural gas is a very good one to be able to check out the curve, the futures curve as a whole, to kind of get a sense of where the direction is going. So you don't get faked out just by looking at the first or intermediate months. And then also understanding the fact that natural gas contracts being priced out too have seasonal factors that already will be priced in, right? So December, January, Feb contracts are going to be fairly high relative to the summer months, June, July, August. And that's because of obviously injection season, and our injection or our ability to replace inventory is a lot quicker, a lot bigger than our consumption taking out of that inventory. So you have a net positive when it comes to providing a positive inventory, which has been the reason why we have seen these price declines. The reason why I don't say, like, I don't know if it's an immediate top yet, and natural gas can reverse fairly quickly. As we talked about, it's probably the most volatile product that is out there. And it has been the one that has destroyed portfolios since the beginning of time. So just be mindful of that. But the price advances have gone out to the August contracts. An August contract right now is trading at $2.94.5. So like I said, $3. Maybe that's going to be your kind of like, keep that in your radar, right, for prices. And if you see a situation where we hit $3 on the front month, but the backward month of that August contract is still trading at $2.94, and now we are in this backwardation, that's where you like Spidey is up. And it's only really for natural gas. Sometimes when you're looking at crude, but crude has kind of changed its market over the last, 3 years, where backwardation is now the norm. Whereas in the past, it's always been in contango or a normalized market for crude. That's just not the case. We're in like just-in-time inventory. Natty's not the same way. We know what the inventory levels are. We know what the production level is when it comes to natural gas. So you kind of want to still see that market in contango in order to kind of give you confidence that this market can continue to move, because that means that the price curve is kind of moving. Well, rising tides is moving all boats in that scenario, rather than seeing a snap and a quick backwardation, which kind of signals the fact that the professional traders out there, the producers, are not pricing in the fact that this actually can last. So that's kind of one thing. And I'll real quick just transition. I know we're going everywhere. Copper is the same way. So just keep that in mind, right? The copper move, and we talked about this last week, and I was not trying to call a top on copper, but I feel like there should be a technical pullback. But just because I feel it could happen doesn't mean that it's going to happen, but it feels like there should be a technical pullback just based on the positioning, based on the flows right now. A lot of the flows that we are seeing on these high volume days, they're intra-market trades or intraday trades. They're not somebody that's layering into a longer position. So you're having pretty much open interest incrementally moving to the upside. And I mean incrementally, like maybe 1,000 contracts a day, maybe 2,000, but you're trading thousands and thousands of contracts a day. That doesn't mean that there's stickiness there. That just means that there's players playing the upside, downside, and you're having these price advances. But when you're looking at the week over week trends for commitment of traders, managed money is pretty much, for the most part, has stalled out. So that's where I was like, maybe we do see a near-term top, but that doesn't mean that's got to happen. But I do know that we will have supply hitting the market in June. And so I think that will be a factor, but you never fade that. And maybe we are in this new, I mean, we're already kind of there, right? It's hitting all-time highs, which is phenomenal, to say the least. The reason why I don't want to go on a quick rant there. The reason why I say that is if you look at the futures curve for copper, it's not in backwardation, it's not in contango, it's flat. And it's been flat for the last couple of weeks with the price action advancing, which is actually bullish. Okay. You don't have a backwardation that's like, oh, this the demand story that everybody has out there. Oh my God, there's immediate demand. Like we don't have enough supply. The world's going to end. That would be a backwardation type of market. We're not pricing that in. Everybody's across the curve is still fairly high, right? We're not in contango, right? Lower prices at the front month, higher prices. We're not in contango, which would indicate a supply glut. We're in a flattened out market. And the thing with that flattened out market that we have seen, especially with the ARB difference between the LME and what we are seeing for the CME contract, that flattening out means that the market is actually pricing in that these prices can sustain at these levels for a long time, at least till January of 2025. Okay. Let me just want to highlight that one more time. Backwardation, immediate demand concern, low supply, FOMO also leads into that. That means that there's an immediate risk at the front end of the curve. You also have a flood of contracts there that can create price volatility to the upside, right? Contango, or a normalized market, front month price contracts cheaper than the further month contracts, usually indicates supply gluts or inventory being at a healthy level, and demand in the immediate term is not something that's going to just not rock these stocks to the upside or completely just drain the inventories. But when you have flattening, it's a mixture of both. And that means that producers have priced in a flat curve or these current levels across the curve until January. That also signifies, yes, supply is a little bit constrained, but that also means that this FOMO narrative that you're hearing in media is not actually being reflected in the overall curve, because if that was the case, we would be in backwardation. So the price stability at this level right now, based on the curve, seems like it's a lot more sustainable than you see out of pretty much any other metal contract right now. And the spread between the LME and the CME is starting to compress, meaning that the CME was outperforming the LME. If you're looking at the per ton basis, yada, 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 right? Like we had this short squeeze. The LME is like, dude, what the hell are you guys doing? Like, yeah, well, there's something there, but we're not moving up. Like we would move up 5%. They're only moving up 1.5% in a particular session. There's a disconnect. Now that disconnect's starting to normalize, and it's not normalizing on the CME front, meaning the contracts that we trade normally continue to rise. Now the London Metals Exchange, those contracts are starting to move up in parity because there's an ARB trade there, right? You could have bought the CME contracts and sold the LMEs. You could have sold the LMEs, blah, blah, blah. So we're starting to see that. So I just, price action wise, technically, we should have a pullback. Structurally, the pullback could be quick, swift, but maybe not long lasting unless we have a significant development when it comes to supply. There was a company, and I don't know I forgot the name of it. I just saw the headline that they do actually plan on increasing their production of some mine in Peru by like 20% this year alone because of the physical demand story that they have there. So the copper companies know exactly what's happening. It's Southern Copper. Yeah, SCCO, Southern Copper. So they know what's happening right now. Southern Copper Corporation, SCCO, they provided some updates on their production levels. So they see what's happening. But I just wanted to highlight that two different scenarios, two different type of structures, two different type of price actions in each of those markets.
Yeah, and I agree. And looking at the chart, basically this is commercials to funds or large speculators or whatever you want to say for that. But you're seeing this massive spread here. If you look at the right side of the screen, you're seeing this massive spread where copper has broken out. And once again, something to think about, which is that commodities have a tendency of doing that from time to time. Sometimes you'll see these massive runs happen like that. But the one thing that I'll say, to Kevin's point on that, one, we're long copper. And I'm also not a person who just speaks my book to speak my book. I also am always kind of looking for what's the headwind against what I'm doing. And so if we look at copper and we just look at the chart, nothing but the chart, the price action. The price action, when we see these parabolic moves into a major breakout, most of the time, that's the worst style of a breakout that you can get. This is what I would call a C breakout. So I grade them based on like If they're parabolic and they move right into resistance and they break right through resistance, most of the time it comes right back. This happened in gold a while ago. This can happen year after year in many different commodities. So that would be a grade C. What we're seeing in copper is a grade C breakout. But that can change. Grade C breakouts doesn't mean it has to stay that. Think of Bitcoin in 2020. It ended up having that parabolic move to 20,000. This is where all that resistance was. It got right around that level, and it started consolidating sideways. So basically, it went from a C breakout to a breakout. So there's a B breakout. B breakout is that very wide range breakout. Not parabolic per se, but a very wide range, and then a breakout. And then an A breakout is when you get into that very tight range. You see some volatility squeezing, Bollinger Band squeeze, volatility tightening. That can tell you that, hey, this is more of a sustainable move. So what we're really looking for when we see these big parabolic moves is some sort of consolidation. That would tell me that this could move even higher. Now, what we're looking at here with copper is it got above major resistance. The best thing that we could see here to say this move is really sustainable, this move has more upside to go, is if we got up here and we started chopping sideways. If we chop sideways at these highs, there's absolutely more upside probably to go. But I also agree with Kevin where it's like this is the either way, this has to kind of digest here. Like the positioning is so lopsided. The futures curve is not conducive to more upside either. Like this is basically like we're looking at all of the signs saying like, hey, this has to do something here, sideways, chop around, pull back, whatever it is, it has to do something like that here. That would make sense. Now, once again, there's the other side of it, which is, the trend is up, keep moving up your stops, but also as a trader, you have to be tactical. So me being a long-term trader, I'm a trend following trader. It makes perfect sense for me to just sit in trends and go to sleep basically. As a trader who's trading in and out of things, because everybody has a different style. I wouldn't suggest my style of trading for everybody, and I couldn't trade like everybody else either. But if we're looking at something and going, okay, well, somebody else could be a trader where they're looking to sell into resistance, and maybe they already sold into resistance, and then now they're looking for a new entry. What we're talking about here is possible things to look for either a new entry for more upside, or it could be an entry for downside. The positioning being so lopsided, let's say it breaks down, let's say it goes sideways like we're talking about, and let's say it breaks down after that. That could be absolutely a great entry for some downside. So, there's a bunch of ways to trade things, and everybody's time frame is different. So it's good that Kevin and I try to have these discussions and kind of talk about all these different time frames to help all traders. All traders have these different time frames and they do different things. So, someone like me might be sitting in a trend like this. I can handle the volatility. It doesn't bother me as much as other traders. Because the way I size and the way I trade is that way, but other traders might trade it a different way. This might be the only product. There's plenty of people who trade 2 or 3 products, and this could be one of the only things they trade, and it could be the biggest thing in their portfolio, and they can absolutely not handle that downside. The volatility is going to be an issue. So, I think it's good that we cover all that. You had all these charts you sent me, Kevin. If you want to add to that, go ahead.
Yeah, just real quick. Copper is known for triple tops. Rare. I would say somewhat a rarity that you see something that actually triple tops or triple bottoms, right? Copper is known for it. So if you want to do your homework, bring up a weekly chart, go back 20 years. I don't want to call this a super cycle yet. I'm not there yet with the super cycle conversation until we actually have a geopolitical event that will force us to completely change everything. We're not there yet. We have stuff on the horizon. We're out there. So I'm not going to call for a super cycle quite yet. But is a once in a 5-year, 8-year run for copper. Copper usually doesn't do stuff like this. And when it does, it can last and maintain these price ranges, let's say $1 range, for 6 months, 8 months, even a year. So this is not outside of the realm of possibility that This is the first wave. And what I said is it's the king of triple tops. First wave, spike higher, consolidate, we retest, consolidate, we retest. That sounds fairly quick, right? But that could actually happen over a year. So we could actually have these prices fairly elevated for a very long time. And that can also then be a benefit for copper companies. And I hate saying this because I do not advocate, and I'm not providing any advice. I never advocate for like trading a stock over a physical commodity. I don't think that's decent unless you have sustained price. And the sustained price can be copper. Like I said, there hasn't been a trend that I'm looking at right now where copper completely breaks down after making a move like this and not come back and try to retest those highs at least a year later, get fairly close. So king of the triple tops there. Yeah, let's talk about the utility space real quick. So last week, I'm fishing a lake. It's a hydro lake. It has a dam. They generate energy there. And I kept thinking to myself, man, you know, these sectors are doing really well. And I hear this commentary and I continue to hear this like fear about utilities outperforming right now. Mm-hmm. Is there a case to be made for that? A small one, a slice of it. You got to say, yeah, maybe that's late cycle behavior for the S&P 500. That might be the case. But we had a technical, utilities didn't participate in any of this run last year for the most part, right? Continue to break down as we continue to move higher, at least for this year and half of last year. So we had a technical breakout to the upside, breaking the 200 a day moving average, coming back, testing that, breaking out to the upside. Phenomenal chart. I mean, it's one of those textbook type of charts that you love to be able to see if you're a trader, no matter what you trade, crypto to all the way to trading copper futures or whatever, right? Really good textbook trade. But the narrative and the theme that I'm hearing for people why they're buying into utilities was actually a little bit concerning though, right? And they were kind of neglecting some of like the straight just fundamental factors. And I'm not saying that they're wrong, but if you think that the number one reason why why utilities are moving to the upside is because of AI demand, and that's what you're hearing, it's incorrect. They will be a beneficiary, some of them, but not all of them, right? Utilities can outperform in a reflationary environment. They have pricing power. It's something that people cannot avoid. You got to pay your power bill. If you get hot, you need AC. If you get cold, you need to have heat and gas, right? And they continue to have pricing power. We continue to see that within the CPI reports pretty much on a monthly basis. So they have that. Their input cost when it comes to producing power has gone down. One thing that people don't understand or maybe have not noticed, their depreciation costs on a lot of their renewables have been accelerated. And they're doing that from a strategic standpoint, basically meaning they're taking the hits on the front end anytime that they're putting up new infrastructure, especially on the renewables. Because if they draw those depreciation costs down to the downside, it's going to hurt them immediately. But if you expect the lifespan or the duration of the lifespan for a lot of these products like wind energy or solar, if you expect them to last for 20 years, 30 years, 40 years, right, in some respects, and you're depreciating that cost over 5 years or so, then you have it's immediate accretion once you have that full depreciation. So they're kind of front loading a lot of their expenses. The reason why I say this is I have one chart. It's a very messy chart. Can you bring that map up if possible? Bring the map up. And it's a messy chart, guys, but there's a reason and a method to my madness. All right. So this is from the Edison Institute. These are all of the member companies that are part of the electric membership of this particular institution, right? And they're all, for the most part, tied to the grid one way, shape, or form, except for Texas. Texas has like one outlet in order to be able to get spare capacity for electricity, but for the most part, they can't. Now, why do I bring up this messy chart? You see all the different colors there. You see all the titles. Probably not going to be able to see it. I will provide it in the comment links on YouTube. I'll provide it in the Twitter comments as well. The reason why I bring this up, there's still a lot of utility companies that are out there, a lot smaller ones that handle, power and utility in certain regions, right? Some of them are gas, some of them are electric, some of them are hybrid, some of them focus on sewage, some of them work on water utilities. And the reason why I'm bringing this up is because you can't throw a dart at a utility company right now and say that they're going to be the beneficiary of AI. That's the reason why I have this up. The key is going to be looking at the locations for current data centers, and then where we are going to see new data centers being brought on. And then for those companies that are doing that, how they are going to power and spend on the infrastructure. For instance, Google has 2 operations out in Las Vegas where they have a geothermal operation that they have actually built out to power 2 of their data centers. That's completely, for the most part, 100% sustainable, and in fact, putting money back into the grid or putting electricity back into the grid. So they're not actually drawing on any of the power just for these 2 data centers. It's a concept type of situation, pilot, right? But they're doing a phenomenal job with it. I won't go into the logistics of it, but it's a really good idea, and we might see other companies do that. So the reason why I bring this up, you got to be strategic. Where are these locations? Where are these data centers being put? And look at the companies that are around those locations and see what they service. And that is going to be the key. If you have a whole bunch of data centers going to Texas, which I don't know why any company would want to make a long-term move to Texas to make a data center to power AI. Notice that whole statement. To make a data center to power AI when Texas has issues already when it comes to their electrical grid. If it gets too hot or if it gets too cold, they're paying off Bitcoin miners $138 million in a quarter for them not to mine Bitcoin. That doesn't seem like a sustainable place for you to be able to process power for AI. Southern California, another situation, right? Drawing on the grid, hydroelectric power, because we've been in droughts, has also impacted their electricity capabilities or their generation capabilities. Would it be smart to power something like that in Southern Cal? You will get some, but will it be the hub? Maybe not. But Washington State, Oregon, they have the resources, they have the grid capabilities, and you have companies that are trying to open them up there. You have some companies looking at Iowa. You have some companies looking at Minnesota. You have some companies looking out even in Ohio because they have sustainability for their grid. And that's why I'm bringing this up, and that's why I have the chart up here. It's not a monolith. And the last thing I will say here real quick, like NextEra Energy, some of these energy companies or utility companies will be able to benefit from surge pricing, right? So let's say that I'm in Illinois and Colorado needs electricity, right? There's a whole market for that. I can charge a surge price for that, redirect power. That's how you have the capacity. That's how the grid works, right? And they probably will benefit from that. But unless you're a constant servicer of that data center, it's probably not going to have a huge impact on you. NextEra Energy is going to be a really good example. A fair amount of exposure, a lot of exposure when you're looking at Florida power, right? Huge exposure when it comes to renewable energies. But are they really located in the hubs and the big brick and mortar data center places? Maybe not. Do they provide a lot to surge demand in the grid? Yeah, right. So that's where they're going to be a beneficiary of. 2 other points here. Industry experts expect that we're going to be drawing around 35 gigawatt hours of power in order to power these data centers, which sounds like a lot, and it is a lot, right? It is a lot depending on the location, but when you're looking at the holistic type of structure as far as us bringing electricity onto the grid, it's only 0.3% of the capacity that we're going to bring on this year alone. We're at a 3% clip on bringing on electricity capacity, right? It's only 0.3%, 0.3.5%. That's small. That's small. That's a blip in the bucket. So if you're looking at the total infrastructure in the United States and data center demand, it's not a lot, but it's where. And if you're making a long-term play, focus on the locations and where these data centers are being housed and who actually services them, as those are going to be the ones that are going to be able to benefit from the secular growth, and they're not going to have this kind of FOMO trade that we are seeing right now, where pretty much every single utility company out there is seeing positive flows because it's AI narrative. And that's just not going to be the case. A servicer that's in Montana that only services Montana and no one's building out anything in Montana, they're not going to be the beneficiaries. Right. So that's what I wanted to kind of bring up from the utility trade. I think it's a nice trade. You ride that trend until you don't, until it fades out. But understand there's a lot more opportunity for weather events and seasonality shifts and climate change events those are going to be more positive for utilities than AI in the next 6 years. That's the end all case there.
No, I like that. And to your point on the first point on the market and generally, people being so bearish on utilities. It's funny because it's in Market Wizards 1, this is a book back in the 80s. And the thing that I forget who exactly said it. It was one of the traders in the book. It's a book of great traders, and so everybody's has great returns, and Jack Schwager verified a lot of them. And basically, the one thing they talk about is like utilities. There's plenty of time where people think utilities are going to crash the market, and really, like there's a lot of time in bull market scenarios where utilities just leads the way. Sometimes it leads the way. Sometimes it's like you just said, where it's not exactly leading the way. It's just it got beaten to crap over the last few years. It has never really picked up, and now it's finally picking up. Investors usually go from area to area, and then momentum follows it. So investors going, okay, well, this is the one area. Like nobody likes it's why trading is so hard. It's so counterintuitive to everything you would ever do. You don't go to the grocery store and go, man, I want I'm going to grab the bananas that have a little bit of momentum behind their price. Like you wouldn't say that. You would go for what you want and the cheapest one. Like that's usually what people do. So as traders, we kind of go through this thing where we're like, okay, well, I'm going to try to find something that's cheaper than everything else. Even though most of the time the relative strength usually will tell you where you want to be.
Yeah.
But if you go and find something cheaper than everything else, like utilities were, and then there's momentum behind it, and then those momentum seekers start to buy it as well. And then not to mention, a lot of people run a very similar program, ETF traders. They run a very similar model. And that similar model is a model where they use relative strength. They buy 3 or 4 things that are showing the most amount of relative strength, and then they sit on their hands. And usually that's over a 3-month time frame. This system was created by Meb Faber many years ago, probably 15 years ago. And a lot of them use that system and strategy to today. So looking at that, you're seeing where that momentum starts to come in utilities. You're seeing that it is showing relative strength on a 3-month time frame, and that was a little bit ago. And then it hit 52-week highs after that. Then people are chasing the 52-week highs. So you get these big moves kind of like that in something that I don't think really has a ton of upside. Like I don't think utilities has a ton of upside. Now, with that said, it's the market. It could have a ton of upside mainly because of what we're talking about. It could have even more, but I don't think that's exactly the area I'd want to be in this market environment. I think there's many areas that are much better, much more suited for this environment. Utilities, like you said, they have pricing power. But at the same time, it's not usually the one that's going to do well and just historically, when bonds are doing well, when the intermarket signals are the same as they are now, when bonds are doing badly, oil is flat, the dollar is just chopping around. Like usually this isn't an environment that utilities love, or even consumer staples. Neither one of these really love this type of environment. So I agree with you where it's kind of an interesting catch-up trade, but I wouldn't really think that there's a ton of upside left to go.
Yeah, utilities and staples, I'm actually pretty fond of for the latter half of this year.
I'm not against it. I'm more just stating that I do think if you're looking at it, so if we're looking at it in the very short term, I would say like that's a great place to be. If we're looking at it for a 1-year time frame, I'd say I wouldn't want to be in those. To just say time frames, yeah.
Yeah. Well, here's the thing. Here's what I was gonna say. Right, like utilities were attractive.
Mm-hmm.
I wrote about it. They were attractive. Now they've gone up way too fast, and so like you kind of think about it for the next 6 months. If we closed out the year right now and you told me that utilities were up 12%, I think they're up 12%, I think year to date, if I'm not mistaken. And we ended the year right now, I'd be like, that's a hell of a return. Hell of a return. Right. knowing that we're up, 11%, 12%, and we still have 6 months to go, that's the tough one. I was looking at slow and steady kind of winning that race and saying, hey, you can get some cover. You got low beta. You get some cover if we do see a little bit of a slowdown. We saw some inflationary prints that were maybe a little bit hot. Yeah, I mean, I think actually they could have performed even better if Powell didn't kind of say that rate hikes are not going to be on the table for the most part, right? I think utilities probably could have caught another bid. I mean, the XLU probably could have caught another $10, and it could potentially, right? But you have a scenario where, yeah, maybe we do see rates starting to flatten out. Dividend yield looks a little bit more attractive. That's actually not my base case. My base case is the fact that they are seeing margin expansion. There were, I think, the number 1 or number 2 company or sector within this quarter that saw margin expansion and growth, both top and bottom line, and surprises for forecast moving forward. That's an environment where we're just basically trying to seek any type of form of growth, actual fundamental growth in this market. It's been fairly hard outside of the forecasted growth that we're going to get with NVIDIA and some of these semiconductors. But the risk that we have there, slight tangent, with NVIDIA is this is the quarter for comps. This is the quarter. Tomorrow's report is the quarter that makes it very hard moving forward for comps. And now it's going to be the fact that last year forecasted year-over-year growth of 20% top line, whatever, right? Because this was the surprise quarter that kind of kicked everything off. 20% top line. If they report a deceleration of that top line revenue growth number tomorrow, what's the market going to do? We've seen how the market's taking it out on every other company on a year-over-year comps for forecast. Are they going to do the same to NVIDIA? Maybe, maybe not. Secular trend, who knows? But fundamentally, utilities have done fairly well. Staples, once again, have pricing power. And this is also going on the fact that I believe that we will see a slowdown in the economy in the second half of the year. It's not a popular opinion. I'll stick to that. I don't mind not having popular opinions. I have them, I'm sometimes on the same side as everybody else. Sometimes I'm not, but that's just how I am, right? Staples, low beta. Once again, we get a slowdown. Are you going to slow down your consumption when it comes to toothpaste, deodorant, things of that nature? And then we do have a scenario where certain input costs for consumer staples have gone down. And so their margins should be expanding. And we have seen some of that within the staples, low beta. And somebody asked me, Bio Chino asked me this last week. I was on a podcast with him. And he said, are you thinking outright absolute basis for return outperformance compared to some of these other sectors like tech and communication services, or risk adjusted? And I think risk adjusted, yeah. Risk adjusted is the key, right? We could talk about things that can try to skyrocket in price every single day or even fall in price, right? Because we're commodity traders. We look at these type of things, but then you look at risk adjusted and you say, okay, on a relative basis, when we talk about that, we're just talking about relative performance across the curve. If you kind of put like a multiple to it, right? On a relative basis, what do I think can outperform right now? Crude oil or heating oil? Heating oil. Why? Because heating oil's already been destroyed. It's the one that's already been destroyed. What's the risk reward compared to something that's already been knocked down compared to something that's kind of in potentially its first innings of getting knocked down, right? Where heating oil, like how much lower can we really go on that and in a short-term basis? And so I think outright, can they outperform tech? No, I wouldn't call that. But I think if you're cautious on everything that's happening right now, you never want to fade tech. You don't want to fade tech in this environment. You don't want to short semis. You have a small amount of exposure and you find lower beta areas in the market to be able to hide out until you get further clarity. And I like that move in the latter half of this year rather than trying to double down on NVIDIA as it approaches $1,000. And that's just tough for me right now, knowing the reactions that we've seen comps on year-over-year basis for companies across many other industries.
The market is, like you said, everybody's running around trying to find where to find value here. And sometimes it's literally everywhere. I think that's kind of the reason why I still believe we're kind of in this bull run here, because it is everywhere. We also look at the seasonality and the presidential cycle and just cycles in general, and looking at all of these many things, it's really a throw a dart at a couple different sectors and you probably will make a lot of money. But technology is a tough sell. I believe that as well. Now we're still long tech. We haven't got a sell signal in tech, but this happens in our models where we go, okay, well, we start to see energy start to catch up. We start to see utilities. We start to see different areas and breadth kind of show up in these very these beaten down sectors. And then we think that technology is going to fall off, and I believe that as well, or at least start to show relative weakness, but it isn't just yet. So it's kind
concerning too. The concentration is concerning, right? Like
Yes.
that's the one thing.
I don't like that at all.
Yeah, I mean, like, and I'm not trying to be a bear here, right?
Yeah, it's not bearish to say let's find other sectors to be long.
I have a lot of
very
bullish
foolish,
commentary. I have a lot of commentary. We've talked about these over the last 6 months. The fear that I have, and the fear that we've seen in boom bust cycles, and we're not there yet. We don't have the credit risk yet. Credit spreads are decent. There's nothing that says like, well, you don't see what a black swan is until a black swan hits, right? But it's usually the pullbacks are usually when we have concentrated markets, super concentrated markets. For instance, we're at new all-time highs. Let's say 25% of that bottom moving to the upside has been utilities, has been staples, it has been these underloved sectors. Technology kind of like, level out there for a little bit. Now technology is kind of taking the reins. But since Thursday of last week, and even actually last 2 weeks, volume's been fairly light, right? I mean, we could all say that for pretty much every metric. It's been light with liquidity actually showing back up in the markets. Market makers want to do something. It's just traders aren't trading. And this is not the seasonal period yet where people just stop trading. This isn't July 4th weekend. You know what I'm saying? It's not. Usually you get that in the second half of June going into the July, right? In the latter half, that vacation season or whatever. It's like a little early here. Isn't it concerning to people? We're all waiting for NVIDIA. That's crazy to me. If NVIDIA shocks us, and they probably will shock us to the upside, I'm not fading that move at all, right? They have the fundamental case and everything like that. But if you kind of think about it, we have one company right now that's saving us on a relative basis for major price advances for the S&P 500. So I don't like the concentration. In 08, we had the concentration. In 01, we had the concentration. Even when you're looking at that pullback that we had earlier last year, concentrated, right? That was kind of like losing the concentration in Apple and kind of going to something else. So I just don't like the setup. That doesn't mean I'm bearish. I'm just cautious. The last thing I will say, pull up a chart, not you, but for those doing their homework here. I don't think we're in a 2008 cycle by any stretch of the imagination, but in a sense, I mean, the delinquency rates are really much showing us that we are in a pretty bad scenario for 50% of the United States when it comes to their population. And I think you can see that with sentiment numbers that are coming out. And what I'm concerned about is that we are seeing the October of 2007 moment. S&P 500, pull up October 2007, see what happened. We had the 20-day, 50-day cross, bear cross, move to the downside. Stocks continued to advance, slightly got out of that 20, 50-day cross there. You had RSI divergence and a bearish divergence. You had CCI bearish divergence. You had stochastics bearish divergence. You have light volume. And you have a concentrated market. I'm not trying to scare anybody here, but Jason, you model, right? I model, I program. And when you build out algorithmic models, for the most part, it's not a huge sophisticated thing. To really simplify it, what the model looks for is standard deviation moves and outliers and trends, and that do align with past time series of history, right? So what they're going to look at it and they can calculate their own. You don't have to throw a model. You can throw a price model out there depending on how sophisticated it is. And you don't have to say, here's what a MACD is. If you're doing the proper testing on a model, it's going to figure out what a MACD signal is, regardless of if you provide it as an input or not. It's going to recognize those price differentials, right? It does that automatically, depending on the model, right? So when you have these major fades, you have the same type of setups: 20-day, 50-day bear cross, bearish divergence RSI, bearish divergence CCI, bearish divergence MACD. A MACD on a weekly chart. Pull up a weekly chart and tell me if I'm wrong. And let me know if we have a bearish divergence or the cross between the 12 and 26 on the weekly MACD. Go back in history for the last 50 years and tell me how many times that we bucked that trend of us not actually seeing a correction. Let me know, because I can tell you the only time that I saw in the last 25 years is 2007, and that started in October. We stalled out, price action stalled out for 3 months, 4 months, 5 months, and then that's when we had the pullback. We could still have a run to the upside. We have a secular trend that's happening right now. But the concentration of risk, I feel like, is a little bit too much for me. And if I'm building out and I have models that I've been pricing out and been able to perfect over time, an algorithmic signal, once it hits, right? So what's going to change that? And I don't know what's going to change that. I'm not bearish on the market. I'm just saying be very, very cautious. Lofty here. If I wouldn't be adding. If you have NVIDIA, I wouldn't be adding. If you do, add on pullbacks, right? DCA into that position if you're holding for the long term. The short term, I just feel like we should not be in a market that cares more about what NVIDIA is reporting than they care about CPI. That is in an environment like this. That just seems a little bit crazy to me. That's just my 2 cents. Rant is over.
No, dude, I completely agree. I mean, it's when you're looking at anything in general, like you have to always consider a couple things, and one of those things has to be how much attention is on a specific stock and sector. Everything is about semiconductors. I have never seen that in all the years of trading. It was a risk-on sector that, you know, had a lot of speculation around it, and that's about it. There was some companies called NVIDIA and AMD and like, you know, you traded some of those, and that was about it. Like, it wasn't this, hey, you know, the future is here, you gotta buy. Like, you know, like that's continued to be the statement that people have brought up over and over again. And it's like, yes, sure, that's all possible. And sure, not saying it's impossible for something to go up for longer. It's all possible, but forever, you know, no. Like, there's nothing that goes up forever, and cycles shift and change. And let's say the commodities start to pick up and they start to get very strong here, and then they just kind of turn up in such a way that they put so much pressure on technology, and then you also have yields start to move up. That would put so much pressure on that stock. Not to mention more pressure than there already is. There's as much pressure on a stock that I've ever seen in my entire life on it already, and then that's even more pressure. So I really don't, for me, I really hate, and I'm speaking outside of my realm a bit, but I also really don't like trading things that everybody loves, that everybody's like married to. Like, everybody's married to that stock. I asked a trader that I was like complete technician, you know, talked about it in such a cold stone way every single time I brought it up. And then if I brought up, I said, I made a joke and I was like, what's your favorite stock? Because somebody asked in the comments, and he was like, NVIDIA. And I was like, and then I was like, because of the price action? And he was like, no. And he like had like this like whole thesis about it. And I was like, this is getting crazy. Like, this is
there's
where
stocks that have been like that, and there's stocks that have been like that and have performed, right? Like, I mean, like Amazon to a certain extent, right? Apple to a certain extent. So I get it. I'm not negative on the semiconductor space. I'm not negative when it comes to NVIDIA. It just seems like, like you said, I think there's a cohort of people out there that believe that every single company in the S&P 500 is buying a GPU, and that's not the case. It's probably like 15 companies that are actually like doubling down on this stuff. And every other company that needs to have this technology is just going to utilize their cloud resources in order to do so, right? Like that's pretty much the case. The last thing I will say, and I will jump off here. Every market has a cycle, and we see that happen over time. And we are probably at the beginning of one cycle. And diversification is going to be key for this cycle, right? Like you can have exposure to several different semiconductors, and if you have this rising tide lifts all boats type of scenario, then yeah, it does make sense. If you kind of go back into the past, right? Like you had what in the 40s, 50s, rail was a hot thing, right? 60s or 70s and 80s, autos was the hot thing. Those are the number one stocks that were out there. Early 90s, early 2000s, or early 90s going into the 2000s, late 80s, early 90s. What was it? Telecom, right? Number one stocks that were out there. Telephone, right, if you will. Late 80s, early 90s. 90s to 2000, late 90s, early 2000s, you had the tech boom bust. But people kind of forget in 2001, the number one companies that were out there were energy. If you're looking at the S&P 500. We had an internet boom bust cycle, but energy was still the number one sector when you're looking at total market cap, Exxon's, all that stuff, right? We had the war and all that type of situation. Just meaning that we have cycles. And so just because tech is doing what tech does, and tech is a really good thing, you can't just brush it with a broad brush and say tech is just going to continue to lead. At some point in time, that technology will be utilized in other areas and other sectors that will be become the leaders. And I feel like we're at a lofty point. The price advances that we've seen over the last couple of weeks for me have not been something that convinces me that that was just a minor pullback. I feel like that was the first run of us trying to retest. October 2007. That's all I'm
yeah. I mean, there's continued. I mean, if you just look at what was leading sector over time, and 2021, great example. 2021, 2022, energy leading the way, having this massive outperformance, and tech kind of being the laggard. So, it's not that tech is bad. And like, I have people who will come to me and be like, if you bought the Qs 50 years ago, like you made this, like I could do that with every single thing on earth. Of course, if you bought Bitcoin in 2010, like you could do that for everything. The thing that we're trying to say here is, as traders, we have to constantly understand and be in those outperforming sectors. And sometimes the sector is long in the tooth and it starts to show relative weakness. And we want to be in the relative winners, whether they're all going up or not. We want to be in the winners. So no, great talk today. Thanks for coming on. I know you're in the middle of going on vacation, so thanks for jumping on, man. This is a lot of fun. Glad we could do this, and maybe we could figure out a time next week if you get a minute to hop on.
For sure, man. I hope that you have a good rest of your day and have a safe trip as well. And I'll talk to you later, man.
All right, man. Later, Kevin.